For the last 27 years, Motilal Oswal has been putting out annual wealth creation studies, each a gem. Each year they tell us a new way to identify winning stocks that create wealth. This year, their study tells us to classify all stocks into consistents and volatiles. Now, I won't say any more because I may distort it. To learn the lesson, I have with me the man himself, Raamdeo Agrawal. Raamdeo, thank you very much indeed for joining me, and I want to personally thank you for all your wealth creation studies, which are so educating. But in our limited time, consistents and volatiles. Can you explain the theme?
Yeah. Good morning, viewers, and good morning, Lata. You know, it's a pleasure to be here talking about this is the first interaction after my wealth creation study got over yesterday. So, you know, this time we have picked up a subject actually we read a book called Mastering the Market Cycles by Howard Marks, and at that point of time we thought, see, what is happening is in the marketplace, the earnings and other things is being analyzed like to any leg.
Yes.
But what is not, earning side is analyzed a lot, but not the P side. You know, because
you must buy at the right price.
Yeah, buy at the right price, sell at right price, and because of social media and so much of communication, there is a lot of distortion in the prices, which is not coming from the earning side, which is also coming from
the noise.
Noise or multiple side, you know, which is investor psychology. So we started studying that. Then when we said, if you want to identify cyclicals, first you have to identify consistents, because everything is not cyclicals. So we said, let's look at the consistents. And we defined consistents. What is consistent? Like a predictable company, predictable and unpredictable company. So predictable is what? The companies, this is our definition. You can have your own definition. But predictable companies are companies whose earnings, because stocks are slaves of earnings power.
Yes.
So earnings are consistent in the sense that year after year, either it is same or little higher.
Okay. Can we just shift to that plate where we are discussing what are consistents? That plate will come up for you.
Yeah.
What you are saying is that it should be a wealth creator which in the last 10 years has profit growth has dropped below 10 only twice.
Yeah. So these are companies, not wealth creators. We are talking about, see, we are dividing the world into two, consistents and volatiles. Now, what is not consistent is volatile. We made it as simple as possible.
Got it.
So we have to define the consistents. So what is a consistent? Consistent is a company whose earnings are predictable and which are consistent. I would love to have a company whose earnings keep going up 10, 12, 15%, 30% and higher and higher and higher. These companies and the epitome of consistency is HDFC Bank.
Okay.
In last 25 years, there is not a break, whether it is a GFC, whether it is a
COVID or taper
minimum growth. Yeah. Minimum growth is 17%. It looks very unreal, but that's the classic. I mean, it's a dream to have.
Ideal consistent.
Ideal the saying.
I thought you would say even Titan. You say Titan.
No. See, everything has some dark.
Okay.
You know, like one year.
Darknesses.
This is a completely spotless. Okay. So this is but to aspire to be HDFC Bank, what bank has delivered in 25, I think it is almost impossible. Of course, nothing is impossible that way somebody breaks it, but this one has created that consistency. So if somebody wants to understand, just go and look at what they have done in 25 years in terms of earnings. Okay.
Now let me stop you there because it should not show below 10% growth more than twice in a 10-year period. Yeah. And it should never ever show a 50% fall.
Yes, that's it.
Right?
So because
that is consistent.
If something goes from, say you did 100 and next day 150, if it comes to 145, it doesn't become, I mean, this is just a definition. It can be 140, but we are saying.
But have a definition.
Yeah, so up to 10% volatility we have given as consistent.
Okay, now the next one. You said even if you have identified the consistent, enter at the right price.
Yeah.
So what is the formula?
Let's go one by one.
Yes. Sure.
So consistency. So you have to have your own definition, or you take at least to start with our definition, where every 5 years we give one drop of more than 10%. and not more than 50%. Like one of the things is COVID. In COVID period, a lot of good companies, they had complete close down or whatever. So obviously the earnings fell. That doesn't change the company's character. So it is about the character of the company. So character of the company has to be consistent, and that gives predictability. And the moment the market is about jo dikhta hai wo bikta hai. So, you know, as the predictability comes, the valuation of the company keeps rising. And that's why we are not able to explain very modest growth of 10-15% and a lot of this FMCG and all, but they are consistent. But their multiples are running into 75, 80,
because
85.
they're predictable.
Because they are predictable. And then maybe market is predicting a lot longer than what should be done. I mean, what we are used to. Maybe in all the 70, 80 P multiple companies, market is saying, okay, last 25 years has been very good. The next 25 also looks to be as good. One of the big things that India is the most consistent country.
Oh.
Because you are growing at anywhere between say 5-6%.
5 to 7%.
Real.
Yes.
That is real.
Real.
But market is all about nominal. So nominal is anywhere between 10 to 12%.
At least.
So that is given. Now that's a field. So it's a very consistent field of India. On that, all these businesses are playing. So which are the businesses which have mastered this technique of getting their pie year after year without fail? And those are the companies called consistent, and rest all are volatiles, and they come in all shades and colors. So we have done 15-year study. In 15 year, up to 3-year losses, I mean,
yes,
falling below, that we have called it consistent, and they are the basically companies which have outperformed the markets. Then beyond that, 4 years, 5 years, I mean, you'll be surprised, there are companies which 13 out of 15 years, or even 14 out of 15 years, they are inconsistent, up and down, up and down. So there is no cyclicality, and that's why we call them volatiles.
Volatiles. Okay.
Okay, so more the volatility, less is the performance.
What is the attribute of a consistent company? Is it something like competitive landscape, or government doesn't interfere?
So we have noted all those points. See, one of the things is that government is uska role nahi hai. See, first thing is the demand has to be predictable. Like say, if you look at the truck company. Now, if you are a world's best truck company, but demand for the truck goes from 4 lakhs to 2 lakhs and 2 lakhs to 5 lakhs, obviously the underlying leader company will also go up and down. So the nature of demand is extremely important. That's why the FMCG companies, the companies which are catering to the day-to-day requirement, that is the first source of your revenue. So once your revenue line is set as consistent, then you have to look at the cost line. Whether the cost has, you know, that same sanity. Because basically businesses are what? They buy the raw materials or services or whatever and bundle it, add value and give it to you. But if the demand is not there, he can do nothing about it. So one is to have the very consistent demand. Then the competitive forces. Now, in competitive forces, what happens is that is very, very important. You can have multiple players, like say NBFCs or housing finance companies or even the paints and all, which are very consistent companies. They have multiple players, 3 players, 4 players, 5 players, but there is some kind of sanity out there in competition.
It is not destructive competition.
There is no destructive competition. But you can be 2 guys, 3 guys, like you see in telecom.
And still kill each other.
And still kill each other. And there is zero profit, even for the guy who is attacking and the guy who is being attacked. Zero profit. And now in zero profit, what do you do? So, you know...
So a live and let live sector is better.
Yeah. So that is competition. See, one is the nature of demand. Second is the competition. It's a huge thing. And everything is playing together. Nature of demand is very consistent, but competition is very, killing competition. Then third is the government intervention. I mean, government intervention can be so... I mean, government is running government in its own way, but...
over-regulated sectors, like sugar, over-regulated. I take your point.
That is one, but say like HPBP, IOC, they are large companies, 5 lakh, 6 lakh crores turnover. But government's intervention for their own larger objective of managing the economy, controlling the inflation, they intervene and they use their balance sheet for subsidy or whatever. Okay. That destroys the, that brings, see, there are various sides. When you go and study the company, then you realize from where the volatility is coming. But these are the broader points of from where the volatility comes.
Okay, Raamdeo, we will not have much time now.
Sure.
Later on in the evening, of course, we're going to discuss this at length. But, the point that I wanted to make is, how will you benefit from cyclical companies? I mean, those who enter Tata Steel at the right time, or SBI. Yeah. I mean, the PSU banks are going through a huge...
Yeah, so now
it is volatile, but it is money making.
So, no. See, if you are see, so far what we said, buy and hold.
Yes.
I mean, buy right, set tight.
Set right.
Okay. So that was for the consistent companies. That we didn't say.
Yes.
Because we didn't know ourselves.
Okay.
Okay. So that applies. Let me tell you, 85% of market cap is with the consistents.
Oh.
But number of companies are only 15%.
Okay.
But 85% of the companies create only 15% of the market
So
cap.
catch hold of your HDFC Bank, your Titan, your TCS, or whatever you have in that list.
No, it's not that easy.
Okay.
Making money is a little bit bigger art.
Yes.
Okay, but these are the concepts which you have to be on the back of mind the moment you go to play. I mean, you have the flick shot, this shot. So this is one of the flick shots. Okay.
Okay.
But that doesn't complete the entire batting. So this is one of the trick. In this, see, I am telling you one thing. Consistent companies can make money. Volatile companies can also make money. But volatile company goes through, say, in a 10-year period, there will be 5 years consistent, then 3 years volatile, and again 3 years consistent.
Oh.
So during the period of consistency, they also make money.
So you must know when to enter.
Yeah. So when you when there is a debacle in the stock price, like what happened to PSU banks, and today HPCL, BPCL, there is a complete debacle for the company's prices because everything is looking dark. 10,000 crore loss for the quarter or something like that. When there is a debacle, from there the sun rises.
Yes.
And then 3-4 years, government also leaves them peacefully.
Absolutely.
So during that period, you make money. So most of all the money for consistents and volatiles are made during the period of consistency. And all the money is lost during the period of volatility. The thing is that in consistent companies, there will be 8 or 9 years out of 10 years will be consistent.
Yes.
In volatile companies, there will be only 3-4 years consistent and 6-7 years volatility.
Okay.
And that's why the volatile companies don't make money. Consistent company all make most of the money.
Raamdeo, my producer has blown the whistle, so we have to conclude.
Sure.
But this wealth creation study is so rich. It tells you when to enter the consistent companies. I mean, when the price earnings ratio is lower than the median. Volatile companies, you look at the price to book and enter when it is lower than the median price to book. So there are plenty of ideas. There is also a note on wealth destructors. This is quite clearly one of the most valuable books for those who are interested in picking out the right stocks at the right time. But more on that later on in the evening. Raamdeo Agrawal, thank you very much for coming by.
Thanks.
And we will continue the conversation later on in the day. That's it on Bazaar. Chartbusters up next.